Hey everybody, welcome to Trading Capital. We're going to do a quick analysis on the talk of what's happening in the markets, and we've been hearing a lot about this chatter about the yield curve inverting, and that's a lot of economists and analysts love to throw this word around, and it is something to definitely keep your eye on as an investor and trader, because it is one of the most reliable indicators to let you know how the economy is doing, where the economy is heading, and if you use history as any guide into your investment analysis, you have to respect when the 10 to 2 yield curve inverts, and we'll go over what that exactly means and how it's important in the role over the overall economy. On this chart, before we delve into the details, essentially what we're going to explain is the US 10-2 yield curve inversion. And here, this red line that I have drawn across, that's the point of inversion. And you can see that we've hit it here multiple times in history, and often it is the indicator that a potential crash, recession, bust is occurring. You can see here, I'm only going to go back to the 80s, but you can see, in the 70s we had massive inflation. It's very similar to the cycle that we're in. But here we had the 90s recession when the yield curve stayed inverted for quite some time. Recession followed. Here when the yield curve inverted, you had the dot-com tech bust. Here when the yield curve inverted for a decent amount of time, you had the cracks in the housing market showing up, and the housing market crashed due to highly levered loans. And then here, the yield curve didn't go negative, but it touched on that ratio. And then shortly after, the COVID crash happened. So it is a tremendous indicator. It is a valuable one to understand and know why and what happens when the yield curve inverts. But essentially, the 10-year yield and the 2-year yield are what is going to impact the price of bonds. So typically when inflation goes up, the yields should also follow and go up to defend the return on what bonds are being paid. And when yields are going up, it's better for bonds. Sorry, when yields are going down, it's better for bonds. It means bonds are more profitable. When you have rising yields, that typically shows a lot of weakness in the bond market. And when the US 10 and 2 inverts, it simply means that, say you have a loan amount and you're giving your money to the government, it means that the 2-year investment is going to pay a higher return than the 10-year investment, which in basic economics, that is fundamentally broken. When you're giving your money to someone for a longer period of time and locking it in for a longer duration of investment, you should be getting a higher return on investment, ROI, or a higher return on capital. And that is not the case. That's what the scary sign is that it's not showing much confidence in the long-term efficacy in the economy. It's showing that there's potentially a slowdown on the horizon, and it's generally a very bearish indicator for the markets. So you can see here, last 4 major inversions, we had 4 major crashes. If I included the 5th, you would also have a major catalyst event where this was one of the best performing times for gold due to the soaring inflation. So if we just compress this chart and show you how inversion affected the stock market. So we can only start really here in the year 2000, when the stock market had this massive run. As soon as the yield curve went inverted, you put a top in the markets, and you started coming out of this yield curve. You went for almost that double top test, but you started declining significantly, which led to the dot-com bubble bursting. So it shows that's one example of when the yield curve inverts, you have a declining stock market. The second example here is the yield curve inverted all the way in 2005, 2006, late into 2007, it started coming up out of it. And then shortly after, into late 2007, you had the stock market put in a top, and it rolled over significantly, which led to the housing crisis. Last example here, we have in 2020, the yield curve didn't quite invert, but it was on the brink of inversion. And it just shows you how powerful the scenario is, because it didn't invert, but yet we still had the COVID crash. Now, this COVID crash was a black swan event, just like these were, but it often shows you how important the bond market is in determining what is going to happen. The bond market is it's the biggest investment vehicle in the world, so it often supports the thesis that it's the smartest money in the world, it's the most long-term money, it's the most data-dependent money, and it's the big money, institutional money, the fixed income market. So it often is one of the best asset classes to look at in terms of what is coming down down the pipeline. And you often don't know what the crisis is going to be or what the catalyst is, but the bond market often demonstrates cracks in the system and when you should really be concerned in moving defensive. And even when you move defensive in this scenario, the bond market has not performed the way it usually does. And what that means is that we're entering a different economic period that we haven't experienced in more than 40 years. And what that period is accompanying obviously artificial low interest rates, high debt to GDP, and the boogeyman of all, the highest levels of inflation that we've seen for 40 years. So with the yield curve close to inverting, you can see it almost looks like the stock market has put in a top, and I definitely think we have put in a top. And one of the reasons why I think we've put in a top, and typically you've seen several months of delay once the yield curve inverts and then you put in a top, but I think the markets are extra volatile. They are moving at light speed in compared to past cycles. So they're moving a lot faster than what most people anticipate. And I think that's due to the amount of excess dollars and QE that have been in the system. And the fact that we've hit this artificial low interest rate period for so long that we're going to have to start running negative rates very soon. That's just the way the market structure is. In order to keep this bubble going from complete collapse, once it does collapse, the Fed will have to ease policy and lower rates again. To keep inflating this bubble. It's very, as you can see off of this chart, it's very boom and bust, boom and bust, boom and bust cycles. And that's what we're going to be experiencing more frequently, and that's why I think this market dynamic is not favorable for an investor, longer term vision, because the cycles are boom and bust. The typical buy and hold or 60-40 fixed income equity portfolio is not performing as well as it did over the last 30 years. So it's a tremendous amount of experience that investors are losing and having to adjust and adapt. So very, very different climate that we're entering in. And let's just jump onto the inflationary chart. So essentially, let's close this pane here and keep this rates up. So as you can see, once it inverts, it's definitely a strong indicator that something bad is on the horizon. Now the difference between the inversion that's happening here, or close to happening, the difference between this inversion period, and this inversion period is the amount of inflation. So here we have not reached peak inflation. Now the long-term data chart of inflation here goes back all the way to, to 1915, so more than 100 years of data here. And as you can see, we've had many peaks in inflation. So we had it in the 20s, we had it in the 47s, we had it in the 80s here, and it looks like we're coming up to that peak inflation zone. I think you are going to tag this channel and pull back. That'll be your peak area of inflation, around 8.6 or 8.5, just depending on where you tag it. It is a downsloping trend line, so if you start flagging sideways, you could tag it a little bit lower. But around that 8.25% sounds about right. So I do think we're at I do think we're close to peak inflation. I'd be very surprised if you start breaking out of this trend line. In the event that you do break out of this trend line, and you have to remember, inflation is in a raging bull market here. On the weekly basis, it's above all of its key moving averages by a substantial margin. So it is due for a pullback, but when you factor in what's coming down the pipeline for the new CPI data, it's going to take in a lot of the commodity shocks. So when we get the numbers in mid-March, the new CPI and PPI numbers, I think they're going to be already high. We've already had the Cleveland Fed predict that inflation will rise month over month, and that being said, it will affect the year-over-year data as well. So when we do get that extra increase in inflation, I think that's when it sparks the potential move for more of those inflationary hedge assets. I think another month in the pipeline of this, this talk that inflation is not transitory and it is a little more persistent. The Fed has already admitted that. I think the psychology is really going to start changing. It's weird how investment psychology over past cycles has really shown that it takes usually the peak, whether it's a peak price in a stock or an asset class, it usually takes the peak number before the investment sentiment changes in a direction. That peak number is usually what wakes investors up and really kicks them into high gear. So often it's that peak number that changes people's investment dynamics. And we could see a shift into more of the inflationary hedges. Whether or not Bitcoin will be that, it's difficult to say at this point. It certainly has been holding up well. Gold's had its ups and downs. I do think gold's still got a very, very bullish backdrop, while other speculative assets definitely have to go through some sort of margin cleanse and decline. So inflation, I do think it's peaking relatively soon. This trend line is your major long-term resistance, but the difference between this cycle, the housing collapse up here, and the dot-com bubble with this peak, and the 90s recession over here, and then the 80s, pretty much hyperinflationary periods where we started the fiat printing monster, completely removing the gold standard from our system, caused these massive volatile times. But all of these periods have in common is high inflation. And we've certainly got a 40-year high in inflation, which makes this period and this potential economic collapse a lot scarier than the housing market, than the dot-com and the 90s recession. So with more debt in the system and higher inflation, there is a fundamental backdrop for a substantial decline in all assets. This could be the bubble that combines the housing, the stock market, and an economic decline all in one. And if you throw in the bond market, which is truly broken in terms of yielding on a 10-year, 2.5%. That's astronomically poor when inflation's almost going to tag 8% next month. Just looking at the 10-year here, we have hit my interim top around this purple channel, this 2.55%. I do think you have a pullback to the 2% level here. Roughly there is a gap fill, even if you look at it on a weekly basis. There just looks like this gap is screaming to be filled, and that's right at the 2% level. And then I do think you flag sideways, maybe you go back up to test the 2.55 area again. Ultimately, I think you stay in this 2% range to this 2.55% range. You flag sideways and chop around in there before breaking lower. I do not think you break up. According to the downtrend, the 50-year downtrend in rates, I do think you head much lower. And the key level to watch is based off of past cycles. You really want to watch this yellow trend line. If you break this into this downtrend, I think it's going to really signify that something poor is on the horizon, aka the next catalyst, stock market collapse. As you can see here, once you had your rates rising from your major pivot low to pivot low to pivot low, you had your breakdown in the trend, and then you had this massive sell-off until you eventually hit the COVID low. So COVID only hit here around early March in North America, but you had this whole warning period in 2019 with rates collapsing. That was a major bearish sign. As soon as you hit this double bottom area and started flagging sideways, creating this massive multi-year bearish pattern, which showed that there was significant more downside in rates, you had basically more than a year to prepare and adjust your portfolio, or at least smart money did. And that's the beautiful thing about analyzing cycles, is you can often prepare and adjust your portfolio to be ahead of the Fed. The Fed is always late with the curve. So rates were dropping, but the Fed's fund rate was still up high. The Fed only lowered their fund rate down here at the COVID low, when real rates and the interest rates, determined by the market already collapsed. So just little signs like that are able to position you ahead of the masses. And once we break this trend line, that's your line in the sand. You want to be looking to go more defensive, carrying potentially higher levels of cash in your account, certainly not taking on higher risk investments. And the difference between us having a breakdown now, I think we've put the top in the stock market, just like it often indicates when you hit the high in yields, you've put a top in the business cycle. I think accompanying with major long-term resistance in yields and high inflation, I think we've put the top in the overall markets, and there's substantially more downside ahead. This could be a very, very violent correction. When you analyze all of the fundamental backdrops that give you the bearish case, there just seems to be so many factors and comorbidities for this market that are going to really drag down equity and asset prices. Again, yield curve inversion, almost complete. Multi-year highs in inflation, complete. Peak inflation, almost complete. Top in the stock market, I believe so. If we look here on a weekly basis at the SPX, you have put in your top, I believe. Could come up for a double top, but it's highly unlikely that you do. I think you have to correct all the way back down to the weekly 200 MA, which will find significant support. If this turns into a really nasty inversion with inflation not being able to be tamed in a mannerly time period, then watch out. This could be leading on to stagflation and potentially a multi-year recession.